Everyone thinks governments hate cash because of criminals, because of tax evaders, because of the shadow economy. That's the official story, repeated so many times you can almost hear it in your sleep. We're phasing out large bills to stop illegal activity. But the truth is far older, far simpler, and far more uncomfortable. Governments don't fear criminals with cash. They fear citizens with independence. Look closely at any era in history when a state was under pressure, financially, politically, or militarily, and you'll see the same pattern emerge. In 1789, France claimed it issued paper assignats to save the nation. In reality, it was cornered by debt it could not repay. In the 1930s, the United States banned private gold ownership, supposedly to stabilize the economy, but in practice to trap dollars inside the banking system and prevent a run the government couldn't survive. And in 1976 to 1978, when Italy began phasing out its highest denomination lira notes, officials blamed the mafia. The hidden motive was simpler. The state needed to force Italian savings into the banking sector to finance growing deficits. Cash is dangerous not because it is anonymous, but because it is outside. Outside spreadsheets, outside bank ledgers, outside state visibility. A 100 euro bill doesn't report back to the Ministry of Finance. A gold coin never tells a central bank where it has been. And in a world built on promises, government bonds, central bank liabilities, future tax revenues, anything that slips out of the promise loop becomes a threat. If you're listening to this in 2025, you already feel the tension. Limits on cash withdrawals, suspicious activity flags for perfectly ordinary transactions, supermarket chains refusing cash as if hardware stores in 1940s Britain were scanning QR codes. Every generation believes its controls are modern, rational, and justified. But the motives haven't changed since monarchs debased silver coins in the 1200s. Control the medium of exchange, and you control the population's options. Remove the population's escape routes, and you control the population. So when you hear officials explain why cash is outdated, remember this. Every empire in decline has tried to trap its money before it lost its power. Arithmetic doesn't lie, and neither does history. Everyone imagines that the war on cash is a product of the digital age, a Silicon Valley innovation wrapped in government slogans. But the blueprint was drawn long before smartphones, long before apps, long before you and I were even alive. What we're experiencing today is a perfected version of a mechanism that began almost the moment rulers discovered something unsettling. People trust money more than they trust governments. Walk back to 1660s England. The monarchy had just returned after Cromwell's republic, and the crown was drowning in unpaid military debts. Soldiers demanded hard coin. Merchants demanded hard coin. Everyone demanded something the king could not print. So a deal was struck in 1694 with a private consortium of wealthy financiers. They would lend the government £1.2 million, an enormous sum for the time. In return, they received a charter, the right to call themselves the Bank of England. This was the birth of a central bank not as a public service, but as a creditor cartel. The arrangement contained a simple logic. If the state wanted money, it had to borrow, and the best borrowers are those who can enforce repayment by law. But here's the twist. The moment governments tied themselves to debt, cash became a rival. Gold coins allowed the public to save outside the system, to refuse participation in state borrowing. If trust in the government fell, people could exit, hoard coins, bury chests, move their wealth across borders. Every financial panic in the 18th and 19th centuries carried the same fear for officials. What if the people stop holding our paper? What if they stop believing in our promises? Fast forward to the 20th century. After World War I, European governments were broken by expenses they could never repay. Germany in 1923 printed marks until a loaf of bread cost billions. France's franc collapsed in the early 1920s and again in the 1930s. In every case, the crisis had the same root. States had issued more claims than they had gold, goods, or income to back them. Citizens responded instinctively. They fled into physical money, foreign currency, or gold. They escaped the system. Governments learned from this. They realized that you can't run a debt-based economy, what economists politely call a credit system, when the public can opt out. That is how the Great Lock-in began. In 1933, the United States made it illegal for citizens to own monetary gold. Britain followed with tight gold controls. France introduced restrictions on bank withdrawals. Italy and Spain introduced foreign exchange controls so strict that a tourist carrying too many banknotes could be detained. These weren't random policies. They were bricks in a wall designed to trap money inside national systems so governments could keep borrowing, keep spending, keep inflating without facing a public revolt. Think of it like a casino that survives only if players stay at the tables. If they can walk out with chips at any moment, the house collapses the moment confidence dips. Cash, real, physical, portable, untracked money, was the exit door, and so the exit had to be narrowed, monitored, or sealed. By the 1970s, the mechanism matured. When Nixon closed the gold window in 1971, ending the ability of foreign governments to exchange dollars for gold, the world officially entered the age of pure fiat currency, money backed only by confidence. Central banks now had far more freedom to expand credit, manage interest rates, and support governments drowning in deficit spending. But greater freedom demanded greater control. If citizens could still use cash and gold to exit the system, then the entire debt structure was fragile. This is when the modern architecture took shape. Mandatory banking systems, standardized IDs, reporting requirements for withdrawals, transaction tracing, and, eventually, digital records that never disappear. Every reform had a public justification: national security, anti-corruption, anti-terrorism. But behind each justification was the same logic the Bank of England understood in 1694. Governments survive only if their money remains in circulation under their terms, not yours. The crucial moment arrived in the 1990s and early 2000s. Banks digitized, payments became electronic, and states realized something powerful. Digital payments don't merely move money, they produce data. Data is visibility. Visibility is control. Control is revenue, and revenue is survival. A government that can see every transaction, every transfer, every withdrawal is a government that can tax more precisely, borrow more confidently, and intervene more aggressively. It no longer fears bank runs because the public can't pull out what isn't there in physical form. It no longer fears inflation backlash because the public can't easily shelter wealth in anonymous bills. Digital money locks citizens into a circular flow. Earn, spend, pay taxes, repeat. No exits, no shadows, no independence. And now, in the 2020s, the arrival of central bank digital currencies, CBDCs, represents the final stage of the mechanism. A world where the state doesn't just issue money, but programs it. A world where your savings can expire, your spending can be restricted, and your transactions can be approved or denied based on policies written by people you will never meet. All this began centuries ago with a simple discovery. Rulers who could not control money could not control their people. And so the system was built, piece by piece, law by law, crisis by crisis, not to catch criminals, but to catch everyone. Everyone loves a miracle story. And for a brief moment, it really looked like the anti-cash, pro-credit world was a miracle. We got used to tapping cards, moving numbers on screens, borrowing for houses and cars as if credit were oxygen. Governments told us the system was stable. Banks told us the system was efficient. Economists told us the system was scientific. And for a generation, it felt true. The illusion began in the 1950s. Europe was rebuilding after World War II, the United States was pumping dollars into the world through the Marshall Plan, and Japan was launching its industrial rise. Cash still circulated, but something had changed. Trust. People trusted the future. They trusted wages would rise, economies would grow, debts would be manageable. When you trust the future, you don't hoard coins. You take loans, you spend, you invest. Governments noticed. A population that believes tomorrow will be better is far easier to govern today. By the 1970s, even after inflation hit double digits, the system didn't break. It adapted. Central banks raised interest rates, countries floated their currencies, and the world moved into a new era where money was no longer anchored to gold, but to confidence. It was dangerous in theory, yet wildly successful in practice, at least for a while. Because confidence, unlike gold, can be manufactured. It can be legislated, televised, marketed. Then came the 1980s and 1990s, the golden age of the illusion. Reagan and Thatcher deregulated finance. Japan flooded global markets with investment capital. Wall Street invented derivatives. Credit became infinite. Governments learned that if people paid electronically, the entire economy became trackable. Banks learned they could issue far more credit than they held in deposits. Corporations learned they could borrow to buy their own stock, inflating prices that made consumers feel wealthier than their wages justified. It was a form of collective hypnosis. You felt richer because your house was worth more. Governments felt richer because tax receipts rose. Banks felt invincible because they had models predicting risk with decimal precision. No one asked whether the numbers reflected reality or just belief. It didn't matter. The system was expanding, and expansion creates its own proof. As long as new money and new credit were flowing, the dream stayed alive. Cash, during this era, looked old-fashioned. It looked slow. It looked like something your grandfather used to keep in a tin box. Why carry paper when you could carry plastic? Why count bills when a bank could do it for you? We traded autonomy for convenience, and we didn't even notice the trade. That's how illusions work, by giving you something pleasant while taking something essential. Governments exploited the illusion to perfection. They introduced reporting requirements for safety. They imposed withdrawal limits to prevent bank runs. They promoted debit cards for consumer protection. Each step felt harmless because everything was growing. When salaries rise, when stock markets break records, when mortgage approvals come with a smile, no one questions what's being built behind the curtain. And what was being built was a system where cash was becoming irrelevant, not by force, but by seduction. It was never about banning physical money outright, too obvious, too political. It was about making it unnecessary. If you can reduce the use of cash in society to 10%, then eliminating the last 10% becomes trivial. You don't fight people. You let people choose the path that benefits the system. The early 2000s reinforced the illusion further. Online banking arrived. PayPal appeared. Credit scoring became algorithmic. China introduced Union Pay. Europe introduced the euro, creating the largest monetary bloc since the Roman Empire. Everything pointed toward a future where national currencies were no longer bags of paper, but interconnected streams of data. Ironically, the illusion worked not because the system was strong, but because it was fragile. Like a shark, it could survive only by moving. Credit had to expand, transactions had to accelerate, cash use had to shrink. Any slowdown risked exposing how thin the foundations really were. But during the growth phase, no one noticed. Households saw wealth, governments saw stability, banks saw profits. The entire financial world seemed to agree that the new architecture, digital, leveraged, data-driven, was the final stage of economic evolution. We believed this system could last forever because it had momentum, and momentum feels like destiny. The deeper truth is simpler. Systems don't become stable because they grow. They become brittle because they grow faster than their foundations. Everyone assumes financial collapses happen because someone made a mistake. A greedy banker, a reckless government, a miscalculated interest rate. But the real reason is always more mechanical, more merciless. Systems collapse when numbers outgrow reality. And once that happens, politics can stall, spin, deny, and distract, but arithmetic keeps marching. The first crack appeared in 2007, when American families started defaulting on mortgages they could no longer afford. But the deeper truth was this. The system had been built on the assumption that debts could grow faster than incomes forever. When incomes stalled, the illusion shattered. By 2008, the world discovered something astonishing. All the digital traces, all the credit lines, all the derivative contracts. These weren't just numbers on screens. They were obligations. Promises with mathematical weight. And those promises demanded settlement in real money. Except the real money wasn't there. Banks that claimed to be liquid had lent the same dollar multiple times. Governments that claimed to be solvent needed to issue trillions more in debt overnight. Central banks that claimed to be guardians of stability had to break their own rules to keep the system alive. So they did something historically unprecedented. They created money on a scale that would have made a 1920s German printer faint. The Federal Reserve injected over $3 trillion. The European Central Bank followed with its own multi-trillion injections. Japan kept buying assets until it became the largest holder of its own government bonds. Numbers were expanding faster than any economy could justify. This was the moment the war on cash intensified, not by coincidence, but by necessity. If the public had been allowed to withdraw their money in physical form, the entire system would have imploded. In 2015, Greece limited ATM withdrawals to 60 euros per day. India, in 2016, suddenly declared 86% of its cash invalid. The official explanation? Fighting corruption. The real motive? Forcing wealth back into banks whose balance sheets were cracking. The same pattern repeated in China, where mobile payment systems became not just popular but politically encouraged. Once transactions lived inside platforms, the state gained perfect visibility, and banks gained perfect deposits. Look closer at these crises and you'll notice something striking. Politicians never blamed the structure. They blamed participants. Irresponsible borrowers, speculators, tax evaders. But the numbers tell a different story. Between 2000 and 2020, global debt grew from roughly $80 trillion to over $250 trillion. No population tripled its productivity. No government tripled its tax base. No bank tripled its reserves. The only thing that tripled was leverage. Mathematically, the system needed one thing above all: prevent money from leaving, prevent people from opting out. Prevent savings from escaping the digital maze where every dollar, euro, yuan, or rupee could be monitored, taxed, revalued, or frozen. Physical cash threatened that. Gold threatened that. Even informal exchange threatened that. So governments tightened the net. In the 2010s, over 40 countries introduced new cash limits. France capped cash payments at 1,000 euros. Spain capped them at 2,500 euros. Italy oscillated between 3,000 euros and 1,000 euros depending on political winds. Australia proposed a law to criminalize cash transactions over $10,000, punishable by jail. And each time the justification was identical: we're fighting crime. Yet criminals adapted instantly. It was the ordinary population that lost an exit. The deeper collapse wasn't financial, it was conceptual. For decades, people believed banks held their deposits. In reality, banks held claims on claims on claims. For decades, people believed governments could always repay. In reality, most nations were rolling over debts indefinitely. For decades, people believed digital money was simply another form of cash. In reality, it was something fundamentally different: an entry in a ledger controlled by institutions that answer to the state before they answer to you. When the numbers stopped adding up, the true nature of the system became visible. Not an open marketplace, but a controlled reservoir. A reservoir where the water level must never fall because the entire structure depends on it. So the collapse wasn't a single moment. It was a revelation. The revelation that the system was never designed to give you freedom of movement. It was designed to prevent it. And when arithmetic finally exposed the limits, politics did what it always does: tightened control. Everyone believes the fight over money is ideological: left versus right, rich versus poor, bankers versus workers. But step back and you see something clearer. The real battle is visibility. Whoever sees the transactions controls the system. Whoever controls the system controls the population. And in the 2020s, visibility has expanded into something previous governments could only dream about. Look around you. Cash isn't banned. It's simply being squeezed until it becomes irrelevant. Stores claim they don't accept cash for convenience. Banks quietly remove ATMs. Airports demand digital payments for parking. Even vending machines ask for QR codes, like miniature tax collectors. This isn't organic change, it's policy by attrition. Make cash inconvenient, impractical, socially outdated, and people will abandon it on their own. Then the final push becomes easy. What makes this moment different from anything in history is the level of centralization. In the past, even when states tightened control, money remained somewhat plural. You had gold, you had silver, you had foreign currency, you had cash stashed at home. Today, nearly everything flows through a handful of nodes: Visa, MasterCard, PayPal, Alipay, Apple Pay, banking apps. These are not neutral utilities. They are gatekeepers. With a single instruction, they can freeze accounts, reverse payments, or deny service. They don't need to pass laws. Their terms of service function like private legislation. Think about the Canadian trucker protests in 2022. Regardless of politics, something unprecedented happened. Bank accounts of ordinary donors, people who merely sent money, were frozen under emergency powers. No trial, no hearing, just administrative action. The message was unmistakable. Digital money belongs to the system first, to you second. As governments face rising debts, aging populations, shrinking tax bases, and growing political instability, the incentive to tighten this control only grows. The mechanism hasn't changed since 1694. It has only upgraded its software. Limit cash, encourage digital payments, centralize financial rails. Then introduce the crown jewel: programmable central bank digital currencies. CBDCs are not simply digital dollars. They are a new species of money. Unlike cash, which works whether the government approves or not, CBDCs can be shaped, timed, conditioned. A payment can be allowed or blocked. Savings can be penalized or incentivized. Funds can expire. Movement of money can be geographically restricted. This isn't speculation. The European Central Bank, the Bank of England, and the People's Bank of China have all discussed such features openly in policy papers. If money becomes software, then your economic life becomes updatable by someone else. And the most subtle shift is happening right now. In country after country, large payments in cash are already illegal. Try buying a car in France with 10,000 euros cash. Try paying rent in Spain with 3,000 euros cash. Try withdrawing $10,000 in Australia without triggering a mandatory report. The walls are closing, not with drama, but with bureaucracy. Every step is justified with noble intentions. Protect consumers, prevent money laundering, fight terrorism, stop tax evasion. But the pattern is identical to the one that played out in the 1930s, the 1970s, the 2000s. When states face mathematical constraints, they seek control over the exits. They need every dollar, euro, yuan, peso, and rupee inside the visible system so they can tax it, track it, and ultimately, when pressure peaks, redirect it. Even inflation works as a modern echo of older mechanisms. In the 1780s, France printed assignats until bread became luxury. Today, governments don't need printing presses. They have central banks expanding balance sheets. Inflation quietly chips away at your savings, pushing you into riskier assets that the system can monitor. Cash, in such conditions, becomes self-defeating. It loses value daily, so people abandon it voluntarily. Control through erosion instead of force. The most striking consequence is psychological. A generation raised on digital payments now sees cash as suspicious. To pay in cash is to signal deviance. To withdraw large amounts is to trigger questions. Privacy, once normal, is now framed as abnormal. This is perhaps the most powerful echo of all. Control works best when people internalize it, when they no longer resist because resistance feels obsolete. If you want to understand the modern mechanism, you only need this sentence. The future of money is programmable visibility. And visibility always points upward, to institutions, not to individuals. Everyone hopes the story ends with reform, with smarter policy, with better leaders, with technology that liberates rather than confines. But history whispers a different lesson, and it's the one people least want to hear. Systems don't collapse because someone is evil. They collapse because the numbers eventually overpower the narrative. When governments fear cash, they're not really afraid of paper. They're afraid of what paper represents: choice. The ability to step outside the digital perimeter. The ability to say no when the system demands yes. The ability to exist economically without being observed politically. Every empire, every kingdom, every republic that stumbled into overconfidence tried to eliminate that possibility. Rome debased its coins. France outlawed hoarding. Britain seized private gold. Modern states digitize money. Different tools, identical motive. And here is the quiet truth that ties it all together. The more a system depends on your participation, the more aggressively it must prevent your exit. That's why cash becomes suspicious. That's why withdrawal limits shrink. That's why digital rails become mandatory. Not because you're dangerous, but because the system is fragile. If you're hearing this in 2025, remember this moment in history. We are living through the final stage of a centuries-long transition, from money as a private instrument of freedom to money as a public instrument of governance. The question isn't whether CBDCs or cash restrictions are good or bad. The question is whether a society can remain free when every transaction becomes a data point, and every data point becomes a tool of influence. The warning is simple, and every era proves it. When visibility replaces privacy, control replaces consent. And when control replaces consent, trust dissolves. Not because people become rebellious, but because systems that forget the human element, autonomy, dignity, uncertainty, inevitably collapse under the weight of their own precision. Arithmetic cannot be deceived, and neither can history once you learn to read it.